In this video, I'm going to show you how to construct the statement of cash flows from the income statement and the balance sheet from the current year and the prior year. It's important to have a statement of cash flows because it shows me exactly where the money is coming from and where it's going, and I need to know exactly what's going on in that money machine so I can know how to tune it up and get it running best. So we're going to have three different components of cash flow. We're going to have cash flow from operations, and I'll start with that. So here we'll start with cash flow from, let's put cash from operations. And this one I always want to be positive because I want to make sure the operations of the business, the running of that money machine, is coming up with positive cash flows. And if it's not, I want to know why, I want to know how to fix it, and I want to know how long it's going to take to fix it. So what I need to do is look at the current balance sheet and last year's balance sheet and the current income statement. I'm going to start here with net income. Net income is $42,300. Okay, but that's not a cash flow. That's an important thing to get. This is not actual cash that came to you. The reason is there's depreciation in here. Or one of the reasons. That depreciation I'm going to add back. That's always a positive number, $2,000, because that wasn't actually a cash flow. Next, I'm going to look at the following. I'm going to look at accounts receivable and inventories from the prior year, and then look at the next year, or the current year. I'm going to look at the accruals and accounts payable. I'm going to look at the accruals and accounts payable down here. Let me make that a little bit better so I can actually read it. These entries in the balance sheet give me some idea about how cash flows are happening. Let me walk through this example. So delta, I'm going to make a delta here, the Greek letter delta for change in accounts receivable, and the Greek letter delta for change in inventory. Accounts receivable went up $10,400. So for now, let's put $10,400 because that's the change. Inventory went up $3,300. So let's just put that $3,300. Now let's think through what that might mean for cash flow purposes. Think of something you can visualize first. Inventory. If you have a car dealership and you have more cars on the lot, now you have more inventory. How did you get that? You spent money, right? If you have a clothing store, you have more clothes on the floor of your store. You have more inventory, you spent more money. So in order to get inventory, I spend money. That's a negative cash flow. That means I bought more inventory than I sold. Accounts receivable is on the same side of the balance sheet with the assets, so it does the same thing. So you can think about it this way. If the inventory doesn't help you, you can think about the accounts receivable this way. Accounts receivable is money that people owe me. So when I did my sales, right, those sales are not for cash, they're for credit. And if I didn't actually get the cash, then I'm waiting to receive some money. So this net income is overstated in the fact that this 180 is not all cash that was paid, it's some on credit. So my accounts receivable go up. I'm essentially loaning money, right? So if I sell something on credit, I'm loaning you money. So my accounts receivable went up, I've loaned more money. Loaning more money is a negative cash flow. Alright, so now let's look at the other side of the balance sheet, the change in the accounts payable and the change in the accruals. And here again, these are the same side of the balance sheet, so it's going to give you the same sign. They're going to behave the same way. If accounts payable goes up, that's the opposite of accounts receivable, right? That's what I owe my suppliers. So I didn't actually pay these guys, I bought on credit. So I've essentially borrowed, and the difference here is $1,200. And because the accounts payable has gone up, I've essentially borrowed that money. Borrowing money is a positive cash flow. Accruals changed by 100. Accruals, think of it in the simplest possible terms. That salary I owe my employees, I owe them but I haven't paid them. So if you work for me and I owe you money, I've taken this out in my operating expenses, I haven't paid you, those accruals have gone up. It's like borrowing money from my employees. That's a positive number. I add all that up, that's $31,900. and that's positive. So this is good news. I have positive cash flow from operations, so the money machine is actually working here. Alright, let's put, we're going to leave that there, and then in red I'm going to do the cash flow from financing. So where do I get my money? In order to run this money machine, where do I get my money? Oh, by the way, when I did cash flow from operations, note I didn't touch cash. I'm trying to see why cash changed. So I'm not going to look at the cash on the balance sheet just yet. I'm going to see why that changed. Okay, so cash flow from financing. Financing comes from borrowing money, which would be the notes payable, from $2,000 to $2,500. It comes from borrowing money, which would be the current portion of my long-term debt and my long-term debt. And it comes from, do that a little bit better, and it comes from stock. So I'm issuing stock. So I finance by, remember the financing decision, it's either going to be people putting money in by loaning money to us, so we as a company borrow money, or we take on new owners, so we sell stock. So that's what we need to look at. So we need to change the delta in notes payable. Notes payable went from $2,000 last year to $2,500 this year. That's a change of $500. Well, if I owe more money this year than I did last, I must be borrowing money. So that's a positive 500. Next I have change in the current portion of the long-term debt. I put this in here just so you can see what's going on. What happens with the current portion of long-term debt? Remember, as long-term debt gets paid off, as it gets closer to me having to pay it off, it becomes short-term. So last year, I owed money in 2 years, and this year I owe money in 1 year, and it moves from long-term debt to current portion. Here it didn't change. 5,000, 5,000, so 0. If it had gone up, it would be positive. If it had gone down, it would be negative. The next I have the long-term debt. Long-term debt went from $20,000 to $15,000, so it changed 5,000. If you owe less money, what's the only way you can owe less money? You have to pay it, right? So I owed you 20 grand last year. This year I owe you 15 grand. I must have paid you $5,000. It's a negative flow to me. Common stock, and remember, common stock can be split into common stock at par or an additional paid in capital, or you could call it capital surplus, and you would use those two together the same way. But here, common stock is going from 80,000 to 86,000, so the change is $6,000. How do you get is that a positive or a negative cash flow? Well, we as a company sold stock. We have $86,000 worth of stock now instead of 80, so we sold stock. We have new owners of the firm. It's a positive $6,000. Alright, so we have one more thing. Remember, we have dividends. So in the first video we talked about the financing decision and the dividend decision and the investment decision. Cash flow from operations, and kind of think about sort of that's part of my investment. My investment decision. With my dividend decision here, I had money. I had this $42,300 of net income. I get to pay that out. So I'm going to do this. Do this over here. My net income is $42,300. Now I can, if I want to, pay that all out in a form of dividends to my shareholders, or I can put it back in the company as retained earnings. So that's a choice I have to make as the CEO of the firm. And what happened? The last year they had $10,300 of retained earnings. This year $50,300. So they must have kept $40,000 as retained earnings, right? So they take this income and put it in the retained earnings bucket. They put $40,000 of it in the retained earnings bucket. That means they paid out $2,300 as dividends. Why did they do that? I don't know. I don't care. I just know that they did. So that's minus $2,300. So the cash flow from financing was negative $800. So what really happened there is what I used to finance, I have that, let me put this back where it belongs, minus $800, or minus 2,300, sorry, minus 2,300, minus 800. Now, is that good news or bad news? Well, I'm not really sure. It looks like I'm paying down debt, which is good news. I'm paying out dividends. It could be good or bad depending on the company, and I think we can really get into it quite at this level just yet. So let's do the last one here. So we have cash flow from operations, cash flow from financing. Let's look at cash flow from investing. Cash flow from investing, we're going to, for purposes here, just look at cash flow from investing being, did we buy fixed assets? It can also be buying stock in another company, things like that, but we just want to look at, did we buy fixed assets? Well, I don't know. The balance sheet only tells me my net fixed assets. Remember, gross fixed assets, that's the purchase price. So I need to know the gross fixed assets for the prior year and the gross fixed assets for the current year. If I know that, I can look at the difference and it tells me did I buy equipment or not. But I don't know that. I know net fixed assets, which in the prior year was $38,400 and in the current year is $50,500. Now, there's a formula for this. It's a little shorter, but I want to think through the logic of it, and to me that's much better than memorizing the formula, which is correct in your book, but rather than memorizing, I want you to kind of see where that might come from. What's the relationship between gross fixed assets and net fixed assets? Accumulated depreciation. So accumulated depreciation. But I don't know what that was. But here's the trick. It doesn't matter. And I'll show you an example and then let you prove it to yourself. Let's say accumulated depreciation last year was $0. And then what's accumulated depreciation the current year? Well, depreciation was $2,000, so it'd be $2,000. Whatever accumulated depreciation was last year in the prior year, it's going to be $2,000 more in the current year because depreciation on the income statement is $2,000. So I don't care what this number was, this is going to be $2,000 greater. Alright, so let's pick 0. That means gross fixed assets were $38,400. Right, so $38,400 because $38,400 minus 0 is $38,400. That means gross fixed assets this year were $52,500. That means the difference is, so my cash flow from investing, the difference is $14,100. Now, is that positive or negative? Well, you have more plant, property, and equipment. I don't know what type of equipment or property or plant. I don't know exactly what it is, but I know you have more of it. How did you get more stuff? You spent money, so that's negative. Now here's what I want you to try on your own. Pick any number other than 0 here. Pick 1,000, 2,000, 3,000, 5, whatever number you want, and then add 2,000 to it here and see what the difference between these two numbers will be. It will always be 14,100. So the simplest is to pick 0. So now I have the cash flow from investing, the cash flow from operations, the cash flow from financing. By the way, the cash flow from investing being negative, it's probably a good sign, right? I'm buying stuff. I'm buying plant, property, and equipment. I'm probably a growing company. If I'm selling off stuff, I'm probably a shrinking company. It's probably not a good sign for that to be negative. So really, I want the cash flow from operations to be positive. Financing and investing, maybe not, but usually a negative from investing and negative from financing. Those are usually better. But I want that positive from cash flow from operations. But let's add all three of those numbers up, and they add to 17,000. Well, look at the difference in cash. Cash this year is 77. Last year was 60. What's the difference? 17,000. Not a coincidence. All we're doing is a statement of cash flows. All we're trying to do here is very simple. Cash changed on the balance sheet. I can see that. I can do the math, not hard. it went up by $17,000. Maybe it went down by $1,000. Whatever. I want to know why it changed. It changed because cash flow from operations, cash flow from financing, cash flow from investing, those three different things changed. Now I can look at how they changed, and I can say this money machine of a corporation is humming along nicely because the positive cash flow from operations, that's exactly what we need. But if I look at it and that was negative and the others were positive, I have some questions I want to ask. So in short, that's a statement of cash flows. It's really, that's all there is to it, and just doing that in practice. So good luck.